All right, looks like we're live. Welcome everybody to Live Valuation. I'm Midas Moriarty, and today we're going to be taking a look at ticker NRDY, Nerdy Inc. Getting started a little bit late today. I had a few things I had to do in the early afternoon that prevented me from getting started around 2, but here we are. This stream in general I expect to be pretty short. There is way less amount of years to do as far as number crunching for this particular company, since they've only been public for about a year or so, and only have a couple years of available data prior to that. So as I have mentioned when I was leading up to this with the schedule, this company is one that I did hold for a short while when it was in its SPAC phase, and I was leading into its combination and transformation into Nerdy itself, and I was kind of holding on a little bit of an alternative strategy mentality. It was a bit of a short-term position relative to a lot of other positions that I typically have, but the position was definitely not super great for us, but we did get out before it made a lot of its more recent declines. But now that there's the new 10K out, I was very curious to see what the valuation is going to look like now with a proper 10K out, with a proper set of information surrounding their liabilities and leases and other stuff like that. Because with the previous valuation I had to do, I did have to kind of make a bunch of informal kind of assumptions about how various parts of the combination would work out. So now that I have a little bit more of a complete picture with the proper 10K, we can do a little bit of a different valuation. Either way, as I said with our last stream yesterday on Friday, I do already basically expect that this is a few more companies what we're planning to do in the future. Obviously we're doing Nerdy today, but I plan to do Corsair on Monday. And then Turtle Beach is kind of up on the docket after that, probably for Friday. Perhaps Jeffries, I keep saying that's sort of our backup one. I'll fall back if other ones don't show up, but it's possible some of these other 10Ks will show up in the meantime before then, so who knows what we'll do with the rest of the week after that. So I do have a little bit of an interesting revenue model for this particular company to kind of explain where I think its revenues could go depending on how the market it's in shifts, but we will get into that after I finish doing the number crunching, which, like I said, I expect to be relatively short. It operates basically in one segment of business. This company's business is essentially a education supplement company. They offer tutoring services, mostly, well, actually entirely online. They used to have services both in person and online, but since COVID-19 has taken hold, they've shifted entirely to online services. They have a primary subsidiary known as Varsity Tutors, which is basically where all of their revenues come from for the time being, which is, yeah, it's basically just online specialized technology-based tutoring services. So we basically put them into a business consumer services type segmentation with a little bit of a flair towards software with the internet, getting us an unlevered beta of 1.08. Sales capital expectations of 2.08 and adjusted net margin of 6.38. The book value of the debt that we have for them is basically nil, about $5 million, with a weighted average maturity of 2 years. Interest rate is extraordinarily high, around 27%, but that's because it's an undiscounted form of lease liability, so it's not really a real interest rate. It's just kind of the way that that's organized. And as per typical, I've already done the first year of numbers for them, but as I have already said, there's only 4 years worth of information available for me to use, or my bad, 3 years of information available for me to use. So it's gonna be relatively short, but I still will play the fourth quarter earnings call while I work on that, and then we'll cover my revenue model after that.
Good evening, and thank you for attending today's Nerdy fourth quarter 2021 earnings call. My name is Selena, and I will be your moderator. All lines will be muted during the presentation portion of the call, with an opportunity for questions and answers at the end. If you would like to ask a question, please press star 1 on your telephone keypad. I would now like to pass the conference over to our host, Molly Sorg, Head of Investor Relations. Please go ahead.
Good afternoon, and thank you for joining us for NRDY's fourth quarter and full year 2021 earnings call. With me are Chuck Cohn, Founder, Chairman, and Chief Executive Officer of NRDY, and Jason Pello, Chief Financial Officer. Before I turn the call over to Chuck, I'll remind everyone that this discussion will contain forward-looking statements, including but not limited to expectations with respect to NRDY's future financial and operating results, strategy, opportunities, plans, and outlook. These forward-looking statements involve significant risks and uncertainties that could cause actual results to differ materially from expected results. Any forward-looking statements are made as of today's date, and NRDY does not undertake or accept any obligation to publicly release any updates or revisions to any forward-looking statements to reflect any change in expectations or any change in events, conditions, or circumstances on which any such statement is based. Please refer to the disclaimers in today's press release announcing NRDY's fourth quarter and full year results and the company's filings with the SEC for a discussion of the risks. Not all of the financial measures that we will discuss today are prepared in accordance with GAAP. Please refer to today's press release for reconciliations of these non-GAAP measures. With that, let me turn the call over to Chuck. Chuck?
Thanks, Molly, and thank you to everyone who has joined us today. We appreciate your interest in NRDY. We are happy to be back in front of you discussing the strong momentum we built in 2021 and the meaningful opportunities we believe are ahead of us. Let's get started with a few of our 2021 highlights. Last year, NRDY achieved new all-time demand records with full year 2021 revenue growing 35% from the prior year to $140.7 million, and bookings growing nearly 50% over 2020. From a platform perspective, we saw strong engagement with active learners up 46% and online sessions up 73% over 2020, with paid sessions per active expert increasing 19% versus the prior year. The investments we are making in product, technology, sales, and marketing are driving strong customer engagement and retention across existing users and driving growth in new users. These investments are paying off both in terms of driving scale and strong unit economics as our one-to-one customer LTVs continue to grow. Our consumer results demonstrate the continued momentum and strength of our platform-based approach to growth. With technology at our core, we continue to scale in new subjects, formats, and audiences, increasing user engagement. We also launched Varsity Tutors for Schools in August, representing the beginning of an institutional go-to-market strategy to serve new audiences. That institutional strategy over time will focus on schools, universities, businesses, and other organizations. Earlier this month, we contracted with our 100th school district, an important early milestone, but one that represents only scratching the surface of the scale of opportunity we see across the more than 14,000 school districts within the United States. With over $140 million on our balance sheet following the closing of our business combination with TPG Pace Tech Opportunities, our business is more than sufficiently capitalized to fund our company to profitability and to pursue targeted M&A. There's a lot to be excited about here. We're seeing strong business momentum in January and February across our business, including user growth, engagement, bookings, and consumption. As we look ahead to 2022, our business is focused on 3 core themes, all of which we believe will continue to help drive our growth and advance our value proposition and strategic positioning in the market. First, we plan to further penetrate the direct-to-consumer market with enhanced product offerings, audience coverage, and a relentless focus on the customer experience, including self-service capabilities. Second, we are executing on the vast institutional opportunity in front of us as we begin to develop recurring and durable relationships with schools and other institutions. Third, we are building out our scalable technology platform with new products and capabilities to better meet the needs of learners. This platform-oriented approach to growth allows us to utilize the shared capabilities we have developed that serve as the building blocks that can be modified for different markets and audiences, providing significant leverage over time for every dollar invested. In doing so, we're able to build solutions that improve quality, decrease cost, improve convenience, and meet the needs of learners, enabling broad access to high-quality live learning. And as our business scales, we can achieve meaningful operating leverage from the platform investments we are making today. We believe the demand for supplemental learning is rapidly growing as a result of several macro trends we are excited to talk with you about today. First, let's talk about the trends we are seeing on the consumer side of the business. We continue to see that learners and parents are increasingly receptive to using online learning platforms as higher quality, more convenient, and less expensive supplemental learning solutions. This rapid adoption has led to online learning platforms being viewed as normal, further accelerating their appeal and driving overall market expansion, which we believe is just getting started. Nerdy's platform allows us to personalize experiences for learners at scale through technology, making our solutions even more attractive to our customers and enabling us to efficiently target and serve new audiences. As we highlight in our fourth quarter shareholder letter, we believe we are at the beginning of a GPA war, a long-term trend towards heightened and unprecedented levels of competition among students for great grades. Nearly 80% of undergraduate universities have taken a test-optional approach to admissions, no longer requiring ACT or SAT exams. That leaves GPA as the most heavily weighted component of a college application. Students that might have historically distinguished themselves with a standardized test score now must increasingly do so through GPA. A January 2022 survey found that 62% of parents with high school-aged children believe GPA is more important than it has ever been for college-bound students. This focus on GPA is changing the way that many students are thinking about leveraging tutoring and supplemental academic support. In the past, many students historically would cram for short periods of time, measured in weeks, with the objective of achieving a great score on the ACT or SAT. Now, with GPA as the priority, students are focused on maximizing their grades over 4 years across all classes to ensure their highest average possible score. This shift in focus has translated to increased demand for our services, with one-on-one consumer bookings for our middle and high school academic audiences increasing by 43% in the fourth quarter and 41% in 2021 compared to the same periods of the prior year. As we said in November, when learning and outcomes matter to students, our business accelerates. Shifting gears to our professional audience, we are continuing to see rapid growth in this category as professionals increasingly seek to augment their qualifications with advanced certificates and coursework. Bookings in our professional audience grew 77% in the fourth quarter and 91% in 2021 compared to the same periods in the prior years, representing one of our fastest growing audiences among our direct-to-consumer offerings. Importantly, we are seeing these demand trends persist into 2022, driving our decision to strategically invest in further product innovation, sales, marketing, expert supply, and our technology platform. We view these initiatives as having strong ROIs, with each dollar of investment leveraged across multiple audiences, driving revenue growth and scale for years to come. And these strategic investments are coming at the perfect time, supporting our ability to serve as the provider of choice in the $75 billion supplemental learning market as it rapidly shifts from offline to online. On the institutional side, our enthusiasm for the growth potential in this space is influenced by the macro environment we are operating in today. As we enter 2022, the education system in the United States is under tremendous stress, but with immense opportunity for transformation. While COVID accelerated and amplified some of the acute challenges that existed before the pandemic and added incremental headwinds in the process, it also created an environment where new solutions to these challenges are welcome and are actively being pursued. And with the recent advancements in technology, like the learning solutions that Nerdy offers, transforming the way people learn has never been more possible. We believe we are on the brink of what we call the great unbundling of education, as school administrators and educators are beginning to rethink how they can deliver the best outcomes for students looking for new solutions beyond the traditional approach, which historically solved learning demands only with internal and in-person resources. Education leaders are more open than ever to using online solutions and are recognizing the value third-party platforms can bring to complement existing classroom instruction, including in scaling evidence-based high-dosage tutoring. We call this the era of unlimited learning and view this as the beginning of a durable, long-term category trend, a trend that is being recognized by educators, administrators, and policymakers alike. In his speech, Vision for Education in America, delivered last month, Education Secretary Miguel Cardona highlighted that strategies like targeted intensive tutoring can help meet the needs of students and the demands of the economy. He challenged all district leaders to set a goal of giving every child that fell behind during the pandemic at least 30 minutes per day, 3 days a week with a tutor to provide that child with consistent, intensive support, recognizing that we cannot expect classroom teachers to do it all by themselves. We believe NRDY's learning platform as a service can be the unlimited learning solution for school districts, administrators, and educators as they seek to improve student outcomes.
All right, well, we're going to cut it there. As I said, this was going to be pretty short. I only had a couple years of information to put in. In fact, I don't know if anyone was noticing here, this last year, the balance sheet is also basically just kind of a pro forma statement that I had to combine together because I couldn't really get the balance sheet from 2019, even though I could get the income statement and cash flow statement, which is kind of annoying. So basically just kind of had to create my own balance sheet in accordance with TPG Pace's leftover of assets from that, which is a little annoying. Anyway, so looking at the sales capital ratio, we don't even have like an actual sales capital ratio that's any form sustainable whatsoever. Now, I never really talk about this much, but this line directly above the sales capital line that I'm usually looking at right here, this tells what the additional sales for each year relative to the additional capital is. So it kind of is more like an incremental level of the same number. And I don't usually use it very much because I usually prefer to think of like the overall sales to capital ratio and think about how that changes. But since these are only in negative numbers and I don't really have any other viable option to work with that, I'm actually going to think about this number as my base because of the fact that it's the first sales capital ratio that we actually have in accordance with that. And I am going to basically do something a little bit special and different with that and make this equivalent to this number right here as that, so that I actually have a base here, because I can't really have this negative number protruded like this forever, because even if they're going to grow the sales in this year, the likelihood that their capital base won't shift into a positive territory within like a year or two is unlikely. And if I leave it as this base, I feel like it's going to be difficult. I don't know. Maybe I don't need to worry about that, but it's hard to say. But we'll get into that. Now, obviously, the number for the valuation hasn't even shown up yet, and that's because with so few of years, a lot of the rolling average type figures I try to use for my valuations is not even applicable in this. So we need to kind of correct for that a little bit. But before I get into that, I want to cover my projections for revenues, as I was talking about. Now, this is where things get a little bit complicated. They were talking about it a little bit in their call, but they also talk about it here in their letter. If you read it closely here, they talk about the GPA war, which they were talking about in the call. Secular shift from online to learning. Market research estimates the consumer market for supplemental learning in the United States will grow at a 30% compounded rate over the next coming years, reaching upwards of $75 billion by the year 2025. Now I kind of had to dig a little bit and figure out what that information is. A lot of these time series data lines that you see right here as columns all come from the Federal Reserve Economic Data website, which is where I typically like to get a lot of my data from. Now this line right here appears to be what they were sort of talking about, because I can see that in 2020 we have revenues of $62.7 billion, and that's the total revenues for educational services, all establishments, which is a little bit different than what they worded, but you can see how this number would compound at a 30% rate, and within a few years to 2025 it could very well be at $75 billion. So I'm pretty sure this is the line they're talking about, but they said it was educational support services. This appears to be all educational services, not just ones defined as support services, and it also says all establishments. Now this is where things get a little bit more complicated. They are in educational support services. Now there's but they're also what we would call an employer firm, which means they're a firm that specifically employs extra employees to do the work rather than just being a one-person type business, which it turns out the majority of educational services are one-person type businesses because it's usually just one tutor on their own. So the point is this number is not actually a very relevant a revenue base to think about unless they think that they're going to snap up literally all of the private tutors as well. It's like, well, I think you're more likely to compete with the commercialized tutor base more than anything else. So I think that number isn't a very useful revenue based line off. Instead, I'm going to pay attention to total revenue for educational support services, all establishment employer firms, which, as you can notice, is like a fraction of that. It's maybe like a third, it looks like, or a fourth, depending on which year you're looking at. Now, the numbers from the Federal Reserve only go up to here, and I started to make projections for where I think these revenues go from that. And to make these projections, I got various numbers about total retail sales, e-commerce retail sales, and then e-commerce retail sales as a percent of total sales, and basically figured out a kind of a regression line to figure out where I think the revenues could go for these revenues in the future. At the end of that, I essentially come up with $27.3 billion of revenue for educational support service employer firms in 2027, which is the year that's relevant to me. But I also needed to find out the e-commerce number for the same figure, which I used those ratios of e-commerce to retail sales in order to figure out. And the e-commerce revenue educational employer firms number only went up to 2014. So that's another reason why I had to be able to come up with a good ratio, is to sort of extrapolate forward what I think that it could be in not only this year, but in the future. And with that, I end up with $13.4 billion in revenue of e-commerce educational service employer firm revenues. So those are my two revenue bases that are of most importance. Down in this chart is the kind of the information all kind of categorized together. These pieces over here are me trying to figure out what types of market share I think could be used, but we'll just pay attention to the chart for now. We have the two lines: total revenue, educational support service employer firms, and e-commerce revenues, educational support services employer firms. This is the revenue in 2021, $8.4 billion, $19.8 billion. This is the revenue in 2027, $27.3 billion, $13.4 billion. That's a 5.5% revenue growth per year for that. And it's almost 8% revenue growth per year for that. So you can see e-commerce is growing at a faster rate than the normal educational support services. So now let's think about market share. This is a pretty commoditized type business where if your one tutor isn't working for you, you can move on to another tutor. And technological aspects maybe makes it a little bit less commoditized, but I'm not going to think about very large market shares for a company like this. And so basically for my worst case, mid case, and kind of best case, I'm going to think about 1%, 2%, and 5% market share. Now, the market share that's most relevant is the line that they're most relevantly on, which is the e-commerce one, which gets me to revenues in 2027 of 134 million in the worst case scenario to 671 million in the best case scenario. Now, this other revenue line where it's the total educational support service, I think about what if they expanded their business beyond e-commerce again, back into other types of educational support service. So they expanded it and penetrated the extra new markets. Let's assume that they also do 1%, 2%, 5% in that case, which could maybe eke out an extra 139 million in the worst case scenario to possibly 697 extra revenue in the best case scenario. So now this line over here, I basically add the two together. And then I discount them at different rates depending on the worst case scenario and the best case scenario. I'm willing to discount the worst case scenario less than my best case scenario because I think the higher up the best case scenario is in this projection, the more uncertain I am. So 10%, 25%, 33% discounts across the board, and that gets me to revenues of 246 million in the worst case scenario to 916 million in the best case scenario. Which, if you compare that to their current revenues, that gets them 12% revenue growth in the worst case scenario to 46% revenue growth in the best case scenario for NRDY. On average, between these three numbers, with no weightings between them special, you end up with 30%. So that's going to be the numbers we use for our revenue projections, 12% to 46%, and we'll try to maybe the analyst would be 30%. We'll go ahead and put those numbers in right now. Was it 46%? Yeah, okay, 46%, and then 30 here. Or maybe I'll just do the mid case 24. and then we'll maybe lean towards 30 in the probabilities. I'm not sure. So that's going to be what we're doing for the revenues. Now, you may have also noticed I had this other chart down here. Now, this is where I compare some other companies in similar and somewhat different segments of business. This is the segment of companies that I chose to compare. Some of them are more similar to Nerdy than others, but others reflect where I think the company could go in the long run as well. Others have more technological comparisons. Others have more educational comparison. So it's like, this isn't like, it's not like all these companies are actually all like each other. It's that all of them are like Nerdy in different ways, and to a certain extent. And it's the small sample size that I chose to use for my comp group, essentially. And this is what the information that I picked up. I got market caps across the board here. I end up with a median market cap of 2.1 billion, 2.2 as an average, enterprise value 2.3 billion average, 2.5 or 2.3 billion median, 2.5 billion average. So there's not very much debt for the companies in this segment, which gets us an implied debt to equity ratio, a median of 5.5 with an average of 11.5. So that gets us an idea of where we can put our debt to equity ratio. We have trailing PE, a median of 20, an average of over 2,000, which is kind of crazy. Because of Chegg right here. Forward PE though, however, we end up with a median average is the same. Both the case it's 19, mostly just because it's an average between these two. So it's kind of a small sample there. Enterprise value to revenue, which is like price to sales, but corrected for debt. We end up with a median and an average case of 1.5 to 2. Price to book. Also, I got operating margins, which we're also going to use for evaluation. A median of 7%, 2% is an average. Then we also have return on assets, return on equity, and sales to capital ratio. I went and calculated the sales to capital ratio for these companies. Specifically, it got to a median of 0.71, an average of over 1. And then I also took a weighted average for these particular effects based off of the weighting of these companies, based off of a certain weighting that I decided based off of how close I thought they were to Nerdy. It's basically I ranked these companies based off how close they were to Nerdy, and I weighted it accordingly with that. So it's a little bit of a subjective weighting. But either way, it got me a little bit of a different information here. Operating margins 4%, sales capital of 1. So it's like these are kind of things that we use in our evaluation. So we're going to try to think about these as potential markers of where we want our information to go. So we'll start at the bottom with the debt to equity ratio. As we were saying, we see it possibly moving to like a 5 to 10 range, depending on how you measure it. So let's perhaps move this up to like 20%, this up to 10%. We don't want to push it too much, but that gets us to a current space of about 10, which is maybe a little bit higher than we want. So maybe 5% here. We do need to correct a few things here in order to make sure that we can actually have the valuation coming in. Pay no attention to that. It definitely is not equal to that. It just has some weird things going on that we need to correct for. Hold on. There's got to be something. Tax rate, that might be part of it. Hold on a minute. There's got to be a problem in one of these base assumptions somewhere. Let me figure out where I typed something that's screwing this up. I think it's the debt to equity ratio assumption. You can't actually go up to that point because of a few of the yeah, okay. So it's because I wasn't correcting for the form of the weighted average cost of capital. Okay, so now let me go back to making the other assumptions to kind of make sure that didn't look like something absolutely ridiculous. Now, for debt to equity ratio, we have it 4.7. We did kind of want it to go a little bit higher than that, probably closer to like 5 to 6% is kind of where we would want it to go based off of our comp group. So let's maybe push this up to 12, which was a little bit more in line with that. That gets us to 5.5. Maybe push this to 5 and then this back down to 10. That puts it at 5. Okay, so we'll leave that at there. Now for the sales to capital ratio, this is where things are a little bit tricky. Let me try to put this back in to see if it actually screws up the formula or not, or if I should actually just do this kind of special case thing that I'm doing here. Now for the sales to capital ratio, obviously the industrial grouping goes to 2, and then with our comp group we were only getting to kind of weighted average of 1.15. However, the thing about sales capital ratios is that it's negative right now because they don't have a large enough capital base. So once they build into a large enough capital base and they have still a decent amount of revenues, it's actually going to make their sales capital ratio really, really high initially, and then it's going to move down towards a more typical number. So I actually kind of want this center number here to be like 5 or like 4 or something, because that actually makes this the idea of like once it flips positive, it means it's going to jump up to like maybe a high number like 4 or 8 or something, and then it's going to move downward to 2 as they build their capital base, because they're not going to be able to grow their revenues faster enough. They're going to have to build the capital base faster than the revenues, essentially. So we're going to leave kind of that assumption in like that. That it does indeed have to be higher, which is why even though we raise the sales capital ratio on the worst case scenario here, it actually dropped the value because basically it assumes that they're not as far along in that process. It's a little bit of a backwards kind of way of thinking about this, but it makes sense. So that puts our sales capital ratio assumption at 4, which seems extraordinarily high, but because of the special circumstances, that's actually correct in that circumstance. Now we have to think about margins. With the margins that we came up with, the operating margins over here, we have the weighted average of around 4 with a median of 7 and 2. We also had the industrial grouping of a 6 to 6.5 or so. So we'll use the best case scenario of the 7 or so, and then we'll also assume maybe a best case of maybe even 50% higher than that, which would be like possibly 10%. Now in the worst case scenario, we actually want to get this kind of as low as we can without actually making the terminal number go below, although that makes sense. Hold on. Yeah, we'll just leave it at 1. There's no reason trying to inch it further. Now this one's way too high. We'll probably see what 5 is, maybe 4, because we did want it to be a little bit lower than that. Yeah, weighted average around 4. So it gets us a midpoint about 5.5, leaning a little bit lower than that. We could argue that the 10 is still maybe a little bit high on that front, especially since the better case of it. What was literally the best one? Yeah, the best one was about 10%. So I mean, maybe it's not unreasonable to assume to get 10%, but definitely not beyond that. I am probably going to lean a little bit downward in my probabilities on this for this one, so that's gonna edge this a little bit lower as well, which makes me feel a little bit more confident. That makes more sense in my mind. Return on invested capital expectations about 70%, but that's partially, like I said, it's gonna be a relatively low capital base for the initial time being. Let's use this as the now. Let me see any other things we need to do before we adjust for dilution. That part we still haven't done. There is a special kind of formula for dilution I have built into this, which is based off of first doing evaluation without any of the dilution effects in place, and then we do and then we add them after the fact. So it's a little bit of a strange counterintuitive thing, but let's see. Ratio 5. Okay. Anything else before I move on to that part? I don't want to do the other stuff until I get to that part. Let's see. All right. I don't know, maybe I'll make these nice round numbers just because I like nice round numbers. It makes them lower on this one, but then we'll raise it up on this one. 485. It is also worth noting that they're guiding to just under 200 million revenues in this next year. So this more optimistic account is kind of in line with their expectations for that. But then again, we have to assume the same growth rate past that point. So it's whether or not they would actually be able to continue that same growth rate or not is really at the same clip, because I could see them getting this point, but then drifting a little bit lower in the growth rate as they move forward, so that maybe they end up at this point by the time they reach the 5-year 4 period, or possibly even lower, you know. So that's kind of the thing. It's like they could achieve this year and then have way slower growth accordingly, and not just make up that same line. So even though this is sort of where they're guiding, I still think that they're likely to end up 27% growth rate or lower over a 5-year period. I definitely think that makes much more sense to assume that than the alternative. Another reason why I'm essentially just extra justifying my my inching of the numbers a little bit lower, like that, because like this weighted one is still higher than that. But to be fair, I also haven't adjusted probabilities yet, so that's the other factor, which is to say, I think this is maybe a more reasonable probability distribution to have. In fact, actually, maybe even something like that. Let's assume 10% chance that they only grow the revenues by about 50% over the next 5 years, which would be very disappointing, but it would still actually be decent growth, all considered. It just wouldn't be the type of growth that they were expecting to get. And then 25% chance that they more than double their revenues, which is still not really what they were hoping to get, but it would still be really, really good growth. And then 30% chance that they do kind of sustain the growth levels that they're essentially implying that they'll get, while still also leaving about 20% chance for even higher expectations. So I think that's a pretty reasonable distribution to leave in. As far as the revenues go, let's make sure that those assumptions line in with our other assumptions very well. The expected margin 4.82, that puts us in line with kind of where we wanted to be, so I'm okay with that. It's actually, I think, perhaps even doing them the reasonable favor. The one thing we could do here is argue about this 3-year average, because this assumes that they're going to go back down to this type of net margin this next year, and that means that they're going to take these losses for the next several years here. So you can argue that this 3-year average does not make sense for a base year, and that we should use a 2-year average or a 1-year average. I feel with the fact that they have managed to increase it here, I don't know whether or not I would assume that they could start being profitable next year immediately. Okay, well, it doesn't immediately assume that, so that was kind of my reservations. I didn't want to assume that they were going to be profitable this year, but instead assume that they would be profitable the year after that. But if I use this first year as the base year, that actually works out very well, so I'm willing to do that, which did give them a little bit of a boost, so that's good for them. Now let's move further down the line to the sales capital ratio. We'll double check all of that again. We did decide to leave the negative in there. It doesn't really make a difference in this particular case. There are some circumstances where that could have made a big difference. In this case, it didn't really do it. So it's just kind of a different, I wasn't certain how that was going to play out. Now, this is still an uncertainty part where increasing this still leaves this part be uncertain. So this could be significantly higher, which could bring down the value, though it doesn't actually bring down the value too much. So I think I might actually just leave it in as a way of being extra conservative. Because like I said, once the capital base grows to a certain point, it will flip to positive, and once it flips to positive, it becomes the denominator over the revenue. So that's why I'm saying is, like, as soon as it goes from negative to positive, it's actually going to be a very large number initially, unless they lose all their revenues immediately. And then it's going to shift down as they fail to gain revenues at the same rate as they grow their capital base. So it makes sense to project this up to a higher number. It just doesn't make sense. Well, that's because we brought the capital base to 0, which also makes the divided number 0, which is why we're getting an error code there. So yeah, it's like that's part of the issue with these calculations, is that the sales to capital ratio is based off of a ratio, which means that if the capital base goes from negative to positive, it actually creates the opposite dynamic from what you would normally expect to see. So normally we would have a higher sales to capital ratio being beneficial for a company, but in this case, because that actually assumes they're further along in their development, high sales to capital ratio is more punishing. Okay, so I think that's about it. We just need to do the default rates and then the equity dilution, and that would be it. We'll do the default rates first, because like I said, the equity dilution kind of has to be done last. Now taking a look at terminal capital levels, we can leave 0% chance of default in that case, and then we have a pretty reasonable amount of chance in the other scenarios. Yeah, see, these worst case scenario ones definitely chip some of the value off. Okay, so that's the default risks, and now that leaves us with our final case for the actual outcomes, but that doesn't affect for the equity share dilution. This is where things get complicated, because they do have a series of legacy shareholders with special share rights that's going to affect the value depending on where the value ends up in these special cases, which I've built a special little thing over here in the notes section for how we're going to do it. Now, different amounts of shares will be added to the pile depending on where the shares are, if it's above 12, above 14, or above 16 at various points. So we needed to find out where the values could theoretically be at those points first, which we can see here that under 3 out of the 6 outcomes, they're going to be higher than 12. 2 out of the 6 outcomes, they're going to be higher than 14, and 1 out of the 6 outcomes, they're going to be higher than 16. So we need to essentially add those in, which we do here, by adding that, which these ratios come back over into here, and that effectively adds 44.4 million shares to the 83.9 million shares that were already listed as it. So the total diluted share count that we would have under the circumstances of our valuation, assuming our valuation holds, the diluted share count would actually become 128.3 million. So that's the share count we have to use, which, as you can see, that brought the value down a decent bit as well. But that corrects for the dilution that we can expect under those circumstances. So that should give us basically the end valuation here. That'll do it for Nerdy. As I had said, it was going to be a relatively short valuation. We did kind of get caught a little bit in some of the weeds for explaining the details of how I got the projections there and dealing with some of the weirdness in our template for how it deals with young companies can be a little weird. It's, like I said, the sales capital ratio thing. But yeah, so ticker NRDY. The U.S. Treasury selling for around 1.967%. Mature market equity risk premium 5.1% as I calculate. I come to a discount rate for Nerdy of 7.53%. They do not pay a dividend currently. They currently have sales of $141 million. No real sales growth to speak of over any sort of longer period of time because they only have a couple of years of history that we have public records for. Sales to capital ratio is currently in negative territory due to their really depressed capital base from being a recent IPO. But they do have industrial expectations of somewhere in the vicinity of around 2 over the long run. Returns on invested capital in the most recent year is around 7%. So it's actually kind of interesting to see that they do have a positive return on invested capital and under these circumstances. It's kind of odd that they have the negative in one, positive the other, but it's not impossible, just kind of an unlikely thing normally. Debt to equity ratio, basically no debt, really just about a 1%. And the default risk, that's actually not accurate. We need to, it's actually 0.69 if it's at that level, but whatever. And the profit margins in the most recent year is negative 2.69% against industrial expectations that we have for them of about 6.38%. They're currently have no profit, again, negative profit margins, currently selling for $4.19. Now, the probability distribution we use for the company is pretty heavily tilted towards the less optimistic ends of the model. We actually put 10% in our worst case scenario when we usually only have 5% in our worst and best case scenarios. And it is still pretty heavily tilted towards these other lower ends. It's like, what is it here? 70 or 65% of the total percentages here are at the median or below. Well, technically this 15 is also there. So actually 80% of the outcomes are at the median case or below, with only about 15% of the outcomes for the very optimistic ends of it. So, we're being pretty conservative in our assumptions, even though we're leaving lots of potentialities for growth here. The revenue projections we have is, in a worst case scenario, $227 million in the 5-year forward period. The best case scenario, possibly $902 million. On an expected basis, we're seeing about $456 million, which is anywhere from 10% sales growth in the worst case scenario to possibly 45% in the best case, about 25.5% on an expected basis, which, that's pretty insane growth. You might be like, holy crap, how are they really going to grow that much? But as I said, the management themselves is guiding to just under 200 million in this next year alone. So that would be like another 35% or something sales growth this year compared to the just under 40% last year, compared to the I think it was like 25% the year before that. So getting these growth rates are already in line. It's just a question of how much longer they can really keep going with that. So expected basis, we see 25% per year for the next 5 years. Sales to capital ratio, we have projections of anywhere from 3 to 8. On expected basis, 5.3, which, as I said, this is kind of the weirder part of our valuation, because it assumes kind of a weird thing about the sales to capital ratio, which is that the capital base can go from negative to positive and then create a strange reversal dynamic, where normally speaking high sales capital ratios are a good thing, but in this case it's actually punishing them by keeping the sales capital ratio higher in this more immediate period. So this line isn't super meaningful, but this is still the information that was put into our valuation to get the outcome we got. We have returns on invested capital pretty extraordinarily high. They're also not super meaningful, partially for the same reasons that the capital base is kind of in a weird place. Then if it's not in a truly final state, then the returns on invested capital aren't going to be in truly final state. And the point is Nerdy's just not going to be in a perpetual final state in 5 years. It's just not likely, unless it's one of these worser outcomes, which would not be super great. But the point is yeah, so that's why these numbers are so high. But honestly, that's not necessarily super indicative of a great investment for them. Debt to equity ratio, we on expected basis we have about 5.5%, which this is another thing that can definitely be a little bit all over the place. With 1% as their current level, it's definitely would require them to issue a significant amount of debt to do that. And in a lot of ways, this is actually a benefit to assume that they do that, because if they don't do that, that means the equity shareholder has to pay for all of it. So it could be a little bit all over the place, but on an expected basis, we see about 5.5%. Default risk over the period, there is a pretty significant amount of default risk over the period. In some of these better case scenarios, it doesn't really exist, but they are a money losing company that has a cash cushion, so that expected default risk is there. And this isn't necessarily the risk that they're gonna fail to be an operating company. It's the risk that they're gonna have a loss in a year where they need to raise capital and the capital markets essentially aren't gonna be available to them. So this is it's a thing where they're dependent on the outside world, and so that risk exists. Profit margin expectations, we have a distribution of anywhere from 1% to 10%. On an expected basis, we get 4.83%, which was pretty well informed partially by our comp group that we were using, as well as our industrial grouping. So I think this is a pretty reasonable assumption to have in here. And then that gets us profit assumptions of anywhere from 2 million to 90 million. On an expected basis, 26 million, compared to the present value price that we get after using the discount rate of $7.72, which is 84% higher than the current share price. On a 5-year forward basis, the value target that we have for the company is anywhere from $8.06 in a worst case scenario to possibly $11.99 in a best case scenario. On an expected basis, $11.10 or 11. My bad, I didn't even realize that it actually did this, but the best case scenario is actually not in this particular case here. I think that has to do with the debt to equity ratio being as low as it is in that best case scenario. So that's just another weird thing about this valuation, is that having the low debt to equity ratio in this particular case is actually bad for them because of how young of a company they are. So my apologies. The best case scenario actually is $12.64, which on an expected basis, we have $11.10. But either way, compared to the current share price that they have, that would get us an implied return of 21.52% per year for the next 5 years. That is a pretty crazy return, but it is also pretty heavily backed up by needs for new capital and a lot of revenue growth, and a decent amount of risk also accordingly with it. It is also worth noting that in this worst case scenario, the 5-year forward value target is still higher than the current share price. So even so, you could look at this as a pretty safe bet in terms of, as long as you assume that at least these kind of minimum growth levels are going to occur. So I also have the value score here of 1.59, which is extraordinarily high compared to typical value scores. However, that is taking in these factors into account. And as I said, these are a little bit less meaningful in this valuation than they usually would be in most of my valuations. So in this particular case, this would be a circumstance where I probably wouldn't buy into this company based off of my value score. I would assume that there's flaws in the measure there, which I mean just goes to show that it's like this is that's just a number that I came up with myself. It's an amalgamation of a lot of trial and error, and this valuation right here shows that it's not a perfect measure by any means, and perhaps needs more tweaking in order to fix some of those issues, because of the fact that these things in this particular case don't mean the same thing that they normally mean for most of my valuations. So that's actually distorting this number a bit. Hard to say what the number ought to be, but I don't know, maybe it's like you just think about like what half of that is maybe, and you have a 0.79, so that wouldn't be terrible either, but it really wouldn't be a super buy. But who's to say half is the correct way to think about it? That's just an arbitrary figure. So the short-term pricing is meaningless as well for this company. We don't have analyst projections for them, so definitely don't pay any attention to that section down there. But either way, this is a very interesting company to look at. As I had said on my previous stream, part of the reason that I'm looking at it again, even though I'm no longer holding the company, is because of a friend that I have that has a decent amount of exposure to the company, so I'm kind of paying attention to it partially for his sake. Though, I mean, it's interesting to see that the value is now a totally different circumstance than it was when I was holding it. It's both at a much lower price than where I sold it, and the value projections are looking entirely different than the last time I looked at it. Though there is a lot of these uncertainties here. So that's the thing, is that even if I was to consider buying back into this company, I would still keep it a really, really small position like I did last time, which was a good thing I did last time, because as I said, I did in fact take a loss on it. So that's going to do it for us today. As I said at the start of the stream, we are planning to do Corsair Gaming for our stream on Monday. I've already done a lot of the prep work for that, so that's pretty set in stone. Plus, as I also said on the last stream, it is our second largest position, so we are pretty excited to get around to doing that and seeing where things look on that one. But if you've been watching up to this point, it would be really, really appreciated if you'd like the stream, or subscribe if you're not already subscribed, follow if you're not already followed. Find my social media down in the description and follow me there if you are interested in contacting me in any other way. We do these streams 3 times a week, or 2 times a week in non-earning season periods, usually around the market's close. And we can only grow this channel with your help. So please, please, please share it with other like-minded individuals that like financial analysis to in-depth levels like this. I will catch you all again on